Hello, everyone. Welcome to the first session of our webinar series called Business Families in Transition, Navigating Continuity, Control, and Change Across Generations. There'll be a total of 3 sessions that will be part of this series. We'll do the first one today and the next 2 over the next couple of weeks. The first session, which we'll cover today, will be called the Strategic Review. The purpose of this session is to provide a disciplined framework for families to step back and assess their overall position before decisions are forced upon them. The webinar will be presented by Zach Lucas, who is a lawyer and specialist in this field. He also wears a Taurus hat, works closely in the capacity of a consultant to Taurus, and has helped many of our clients in succession planning matters, which are a part of our Taurus service that we offer. Zach, over to you, please, to start.
Thank you very much, Ruti. Okay, thank you very much for everyone for joining, wherever you are in the world. So it's either good morning or good afternoon, or maybe even good evening. As Ruti mentioned, this is the first of a number of talks that are generic in nature. It's the usual thing that we would do when discussing with business families on projects, what next to do and what's the good advice and what should they be thinking about. But this has been released and allowed for general consumption across the Taurus sort of network. And the series will go through each of the segments that we would ordinarily do in private projects. Now, none of which will result in, I would have thought, any actionable items with respect to the talks. But what it could give rise to is a real consideration of the options. And that's, of course, where we're available after these things to have detailed conversations as to how to take away the learning and then to bring it forward into something that's perhaps remedial, something that's perhaps a vision for the family and the business going forward. Now, before I commence, when you get a copy, if you request a copy of these presentation slides, you will be met by a disclaimer. Now, it's very important that you realize that in no way is this supposed to be specific advice, and the disclaimer sets out the parameters of the basis on which you are allowed access to this information and also to view this presentation. It also sets out what you can and cannot do with the presentation after you've received it. So it's an important disclaimer. I would encourage you to read it if you get copies of this, and also obviously to adhere to the requirements. So the series agenda, as I said, this is the first time we've allowed access to the sort of things that we do in private projects. It obviously is not actionable, as I mentioned, but it will give you an idea of the areas that we cover and the issues that are raised, particularly from a business family context or involvement. So today's talk is the strategic review, and this is basically, ground zero, the basis on which families may assess their strategic options. And it will flesh out different sort of toolkits that you can apply in coming to a conclusion about the overall strategic direction of the family as it relates to the underlying business. The second in the series really talks about the governance framework. What's best practice? What should we be learning here? And effectively, how do we make effective cross-generational decision-making sustainable? So governance is really, I think you should look at it as like software. How do we run the latest iOS for our family? What's the learning here? What's the key takeaways? And then the third session is the governance and succession structures, which brings everything together and then brings in what we would consider to be the hardware. What's the way in which we can structure the software? Do we do a shareholder arrangement? Do we do trusts? Do we look at a will potentially if we were able to create a trust in a will? What's the best approach here? And so, as I say, all of these are going to be generic in nature. They raise the issues. The basis of this is really to try and help Taurus clients and advisors to understand the parameters of what business families are going through, particularly at the crucial stage of cross-generational considerations, which is always a very, very challenging time. So 3 series. Today is the first of the strategic review, and then we've got the others slated to come in the coming weeks and months. So for today's purposes, the agenda. So what's the objective? What are we trying to learn today? What's the key takeaways? The actual strategic review process itself, what's involved in the strategic review. Looking at the sustainability tests that we would undertake. the sufficiency tests that we will undertake, the level of engagement, and then the outcome, effectively the decision that's made, or the options on the decisions that can be made. Now, as we run through the tests, these words of sustainability, sufficiency, and engagement become a lot more clearer. And then we just sum up what's the key takeaway from today's. I think the best way to approach this particular presentation is it's foundational. And it's an important foundational sort of talk because many times this bit's missed out. So this is effectively a top-down approach to how families should engage with this topic in a sensible way. Many times families will do a bottom-up approach, which is you immediately go to structuring. So they'll immediately talk about, all right, we need a private trust company, or we need to have a foundation, but there's no discussion beforehand about what is it that we're actually trying to achieve going forward, and is this the best approach anyway? That missing part becomes more and more damaging as the families then start to adopt structures that effectively are not fit for purpose. So we don't want to do that. We want to do a different approach. We want to do an approach that's sustainable. So a lot of what's going to be talked about is fairly sort of logical, and you would have thought fairly common sense. But it's important to have it in the context that it's the very first touch point that we have in discussing this topic. And then after which it gets more and more granular and a little bit more involved. So not doing a bottom-up approach, but top-down. And this is the top of the pyramid, which is the strategic travel of the family and the strategic direction that they're going to go in, both themselves as well as the business. So that's why it forms an important part, albeit that it's got a lot of common sense aspects to it. So the objective, what are we trying to achieve in today's talk? Understand business family failure. So this is basically, and sorry to start off on a rather depressing note, but this is to set the challenge, right? What are we trying to fight against? What are we trying to achieve? Assess the strategic position of both the family and the business, so bringing them both together. Many times families are looking very carefully at the business performance, but very little is done on the family side. And that's where, unfortunately, some of the failure rates come in. Assess the long-term sustainability of the business. Look very carefully at what that means, and particularly what it means in terms of preservation of wealth, whether it's captured in a business or captured in a financial investment portfolio. Assess long-term sufficiency of the business, and I'll get into what that means, but it's broadly looking at the liquidity requirements of the business and the family cross-generationally. Assess the long-term family commitment to the business, the engagement levels. This is critical, and many families are blessed with children that actually are engaged, competent, and interested. But however, there's a growing cohort of families that are finding it extremely difficult to encourage next generation members to engage. And then still more other families are in desperate positions where they're falling out. And then finally, look at the strategic options. So it's quite an important one, and there's a helpful little diagram which is a little bit functional, but it gives you an idea of the different optionalities and when they should be played into this analysis at the end. Okay, so looking at the strategic review itself. Setting the scene. Succession failure rates with business families are at epic levels, and they have been since records have been kept on this. Now, records have been going back as far as the 1970s with people like the Family Firm Institute picking up on why is it that we have this failure rate, and is it particularly geographically located, or is it particularly to an ethnic origin or of anything like that? And what they find, which has been buttressed by Big Fours looking at this as well, and McKinsey and all the consulting firms looking at this, is a consistency in the record. So generation 1 to generation 2 is like a 70% failure rate. It's a heavy loss. Generation 2 to 3, it gets even worse, 87% failure rate. 3 to 4, 97% failure. So if you've got a family business that's getting to the 100-year mark, you're exceptional. If you've done it without any assistance, then you've probably lied. You've definitely had assistance. You cannot luck it through on this because the statistical odds are massively weighed against you. And that's been the findings over and over and over again. So I think we're pretty set on understanding that we're up against a significant challenge. This is a real business challenge, a real strategic challenge. The causes, again, depressingly familiar. And if anyone's taken any sort of course on this, or if anyone's, been involved in any way with family businesses for a number of years, you will have seen some of this play out. No real succession plan. That's still, even on the latest statistics, we're looking at something like only 20% odd of families actually have a succession plan in place. And we're not talking about an estate plan. There's a difference here. A succession plan really is all-encompassing, both operationally what's going to happen with the business, but also looking at the ownership aspects. So a succession plan is a lot more than just a transfer of ownership, either by virtue of some backing succession law or through a will. So generally speaking, when it comes to business assets, there's a lack of this. Weak governance. Now, generally speaking, at generation one, governance is very strong because there's generally only one person making decisions. But as we go cross-generationally, that begins to weaken. And if we don't have any reforms or anything put in place to professionalize how we make decisions, that's where we end up with weak governance. And that allows in some unhygienic behavior potentially. Lack of professionalization across the business. And that can be borne out by different circumstances where you have, dad's team continues to be his dad's team all the way through, and there's no real reinvestment in new sort of executives. And we don't really professionalize how we manage things. So there's no real robust accounting, there's no robust business planning. It just starts to look more and more like a corner shop, but actually it's a massive factory. So it's long since the sort of operational aspect of it from a strategic standpoint has been long since overpassed by how complex the business has become. It hasn't kept pace, so the lack of professionalization starts to eat in. Financial mismanagement, as we know, some businesses will obviously go through this, and it's generally due to a lack of understanding of the rigors of putting together a comprehensive business plan and sticking to it. Strategic rigidity. This is really, we see a lot of this where it's borne out by the businesses in one sector, and that's basically the only thing that the family are confident to do. They don't want to diversify into other areas, even if they're adjacent. And that rigidity comes with unfortunately, a diminishing aspect, particularly if competition or technology is starting to erode that. Last one I've mentioned here is wealth fragmentation. Now, generally speaking, parents want to do the right thing. So they want to have equal inheritance generally across the board for the children. This is a good idea, but then it becomes a bad idea when it's applied to a business. And it can accelerate the loss of wealth. It can accelerate the failure rate of the business. And because it's playing on some members of the next gen will be interested and competent, and some members will not be interested and not be competent, but they're all lumped in as beneficial owners. And that's the fragmentation aspect is a real accelerant to ultimate business failure if you have that mix. If you're blessed to have all of the children engaged and they're all well motivated and they can actually add value, then that's amazing and that's very good and it's actually exceptional. So what's going on is a bit of a fluke, right? Generally speaking, that's not the experience of most of the business families. But wealth fragmentation of itself, when applied to a business, and what I mean by that is at every generation, the following generation equally inherit the ownership. If you keep doing that, you'll end up with no business. And the reason why is you're going to have this balkanization of members that are in and out, and then you'll have an issue around how they actually want to treat the liquidity of the business, etc. So all of the unhygienic behaviors are all manifested when you have this fragmentation of members that are in and members that are out. So, and we'll get on to strategically what could be doing, what's the advice here if you've got that situation. So the review process itself, the objective. Basically, it's trying to enable you as a business family to assess and decide whether to recommit to the business, introduce some governance reforms, in other words, anticipate the sophistication of the next gen, or begin the process of strategic separation or transition. So in other words, making some very, very big elephant in the room type decisions about the direction of travel of your private wealth. the private wealth is captured in a business and it's illiquid, it's not listed, and it comprises effectively 90% of your wealth, then you're probably first gen. What you should do is the direction of travel should be that you gradually start to rebalance away from 90+% in one factory or one business into balancing away into financial investments. So that's where the successful families that have done this in the past, they've gradually, at each generation, the operating aspect becomes less and less. So let's say at second gen, you may have 70, maybe 60% that's still business-related wealth. By the time it gets to third gen, it should definitely cross the halfway mark. So it should be that maybe something in the region of 30 to 40% is business related and the rest of it's just been rebalanced through financial investments that are diversified. That's basically the approach. That's the advice. And that's what we've got empirical evidence works, right? In terms of holding on to wealth. So the basic concentrate wealth to become wealthy in the first place, but you need to diversify to hold on to it. If you don't, the odds are stacked against you pulling it off generationally. That's the broad thing. So this is designed to flesh out the details of where you are, flesh out the aspects that are important, and then look at whether or not there's actually a decision to be had here, or do we sort of kick it down the road and see what it looks like in a number of years to go. So when should you do this? Proactively, families do it 3 to 5 years. They would do a review. That's on a regular basis, but most often it's spontaneous. It's as a result of a reactive. So there's family changes, market changes, family conflict, litigation, loss of key executives or clients. So there's something that's happened in the market that's pushed us to review up. And it could be, we have more children in the family, or we have a senior passing away. Things like this would be a reactive review. I would encourage, obviously, that you would do this on a proactive basis, because depending on the event that's pushed it, it can be that you are in panic stations. So it's better to try and control this mechanism from the very top, and therefore doing a regular review alongside your business planning would be helpful. And it doesn't have to be forensic. What I'm about to run through doesn't require you to engage Big Four and have massive accounting and all the rest. You can do this literally in a conversation with a piece of paper, and then start to scale up if it looks like it's generating an interesting idea. But generally speaking, you'd want to have some regular basis on which you do this strategic review. So looking at each of the sort of nuts and bolts of each of the tests, and the sort of things that you would want to discuss, and particularly the things that you'd want to look carefully at. So sustainability is really about the health of the business itself. And there's some level of honesty required. So the business review would look at things like this. Obviously, a business is organic, so it'll have a life. It will grow, it will plateau, and it will decline. And that's just because it's surviving in the wild in the marketplace. I think the first stage is to be very honest about where we are as a family and where we are with the business. Is it growing? Is it plateauing? Or is it declining? Obviously, if it's growing massively and you're doing very well, etc., that's good. And it generally means that we can mask off other issues because it's the good times. But you must always understand that everything's cyclical, and there will come a point in time where it will plateau and decline. Now, if you're in a particularly competitive industry, that may happen quite quickly with the advent of technology and other sort of market entrants. But the key bit here is to just take a sense check of how are we doing as a family in terms of this business? Is it growing or is it just declining? Looking very carefully at the market positioning, are we dominant or are we a minority? Are we a major player or are we niche? Or are we in an uncomfortable position of being in the middle, neither here nor there? So again, being very honest with yourself, it doesn't have to be shared with outsiders, but being very honest as a family as to what we really feel about the positioning of our undertaking. Are we diversified as a business? So are we only reliant on one particular provider or one particular market? So for instance, if you are a Taiwanese family, which has 90% of your customers are in China, you may have a long-term, or at least even in a short-term problem if things geopolitically kick off. So diversification then becomes an issue. So looking at profitability, Are we making any money, or do we need to reinvest? Do we need to pivot? How are we doing? It's very important, again, to be honest about the health of the business. The quality and age of senior management team. Generally speaking, if we've got a first generation member who's still in office in their late 70s, the team around them would tend to also be within that cohort, or at least below. And then you need to make an assessment of the quality and the sort of sustainability of that team going forward. It's really tied into this next point, which is the professionalization of non-family executives. A lot of the times when we encounter family businesses, there's been no real attempt at cultivating non-family members for leadership positions, and that's a problem. And many times when we come on the scene, it's pretty much too late to try and cultivate them, because we're dealing with issues that are strategic, that are immediate. And to cultivate non-family executives takes a long time, and it takes enormous amounts of patience. So the professionalization is a key indicator here. And when it comes down to this is, could you sell the business? And if the answer is you couldn't, because no one would buy it, because they would only buy it because of you, then that's a problem, right? Because then you really have got trapped capital. The business planning process. So what does that look like? Is there protocols and governance around it? Is it rigorous, or is it basically, do we have good ideas and impulse sort of management, where we do things surfing the markets or surfing the opportunities without really any coherence? Or do we go through it in a very rigorous way? How mature are we when it comes to our business planning processes and the way that we deploy capital to try and grow the business? Capital reserves, do we have reserves, or are we borrowing? Are we borrowing to meet payroll? Things like this, that's important. Level of debt, how much are we carrying? What's our reinvestment policy like? Are we drawing down every last bit of income, save for normal expenses, and then distributing it across the ownership class? Or do we actually have a reinvestment policy where it's geared towards maybe a strategic pivot to a different market? And finally, risk assessment. Would we consider the business to be risky? In other words, could a market entrant or a competitor come in, or a piece of technology come around which could knock us out in short order? How risky are we in terms of the business? Because if at this stage we have 90% of our wealth trapped in this business, and then something terrible happens, then that's us wiped out. So that assessment has to be taken very seriously. So on sustainability, you're really looking at the business, and I suspect that this is being done, quite regularly, because it is the most important thing. If you don't have a sustainable business, then everything else is just a nice to have. It doesn't matter. So if this is being done, then great. If it's being systematically reviewed, brilliant. The key bit here is to look at the information and then ask yourself the question, are we doing anything about anything being negative on this review? So that's the key bit on the sustainability. Is this something that we can hand off to future generations? Or are we in a sunset business where, for whatever reason, we can't grow anymore, or we're actually losing our market share, year after year? Okay, so sufficiency. Sufficiency is all around liquidity. So it's the liquidity review of current business liquidity requirements. So the amount of money circulating in the business to keep it going, to effectively keep the operations going, and then whether or not we have a strategic reserve, which I'll get down to. The long-term business demands on liquidity. So are we in a phase where we have to capitalize and then start reinvesting, or where is it? And that's obviously going to be borne out from the sustainability review. But looking at this is the lifeblood of the business, and where is it going? So long-term business liquidity demands. The current family liquidity demands. Now, generally speaking, first gen generally don't take much money at all. They're the ones that will sit at the back of the plane, stay at the worst hotels, and pretty much do all of that. Not necessarily the case when you get to third gen. It may not be the same. So third gen may have different liquidity requirements, and that's where looking at next generation projected liquidity demands comes in. Now, this is a sensitive one, because here we're looking at each of the next gen members and asking the simple question, which is, I wonder what they're going to do for a living. because many cases, for whatever reason, will have next-gen members that really want to be within the business as a sort of stipend. Don't really necessarily want to perform, but they want to find something to do, but they're not necessarily going to be adding much value. That does happen, and we're just being honest, right? It does happen within families, and that can create a liquidity drag. But it's more important for the seniors to anticipate some of this and understand it. Now, you may have a family filled with lawyers and accountants who have no interest at all in the business and simply don't have no requirements for liquidity financing for them. That's okay. That's another extreme. But the important aspect here is that we are actually looking at this. We are considering not just what we're doing at first gen, but looking carefully at what second gen or third gen. Now, if we have a business that is not doing particularly well, then and you have a next gen membership class that actually are enjoying a high level of living standard, then you want to look at the scenario of potentially drawing down capital or disposing of assets in order to fund their liquidity requirements. That's a nightmare and that's unsustainable. So that's the sort of matrix that you're getting into with the liquidity is how do we keep the business, what is its requirements and what's its long-term strategic requirements? What do we need as a family to enjoy our lives, but also what can we expect from next gen members going forward? Within this, you would also look carefully at salary and benefits policy. And the key bit here is looking at a number of, and this comes in later sessions when we talk about the governance, but we're looking at whether or not the salary is matching the job, and we're looking at the benefits, whether there's actually a benefits policy at all. But the key bit here for us is this another way in which money's going out, regulated or unregulated from a family perspective, and is it sustainable? Distribution policy, again, are we pulling money from the business on a regularized, agreed basis, which is prudent, or is it ad hoc, depending on the year and how we feel, and whether or not it's a feel-good factor or not? So the distribution policy, is it professionalized? Is it effectively fixed? Or is it something that's completely at the discretion of the senior members and the decisions are a bit ad hoc from year to year? Now, from doing this, if you look at the sustainability, you match it with the sufficiency, you're getting close to what's called the carry capacity, which is, can the business sufficiently carry what's required with respect to both its liquidity requirements as well as the family's liquidity requirements? And then that will give you a projected long-term carry capacity. Now, this is where it starts to get a little bit scary for some families, because that then leads into a projected long-term growth target. Now, this is where potentially you have a mismatch, which is if you've got a business that's burning cash and you've also got family member groups that are also burning cash, and you look at the sufficiency of this match to the sustainability of the business, it will give you effectively a growth target. Now, if that growth target has never been matched by the business in reality, then you know that there's a long-term problem coming forward. It's difficult when you're dealing with senior members of the family, first-generation members, for them to appreciate this, because generally speaking, first-generation members are extremely prudent with cash. Clearly, the business would never have got this far without them being that way and being very careful. But it's difficult for them to extrapolate what it would look like at next gen level and how would they respect the cash generated from the business. But it's required, because if we don't do the sufficiency test, then there's a secret trap in there, which is we have no idea what would happen cross-generationally. We don't know what we're going into. We could go into a situation where next gen are very responsible, and that's great. Or they don't really require the business income to help them, and that's fine as well. So we're all good on those scores. But what we're looking for here is where there's a mismatch between what the business can produce and the expectations of the next gen. Now, on engagement, this is the last of the 3 tests before we start considering the sort of matrix of decisions. On engagement, it is what it's saying. It's a family review, and it's the relationship between the family, its members, and their relationship with the business. So we're looking at the current generation involvement in the business. Usually it's senior level. So if it's siblings, They'll, let's say, second generation, and they have been doing it for 10 plus years, 20 years even, then generally the involvement is very enmeshed, as the literature will tell you, right? So in many cases, the engagement level is not been documented. So they may have a family constitution in the background, but basically members have been working together for so long that they really know what they're doing, and they don't really require any assistance. It pretty much works, save for situations where they potentially could fall out. But generally speaking, it's working, and it doesn't have any backing wires. It's just being done because they've worked long enough together to know where everyone stands and how to treat each other. That's fine, and it's a good position to be in terms of the current generation involvement. But what we're looking at is next generation particularly. That's where the engagement level is. This is where the analysis is really looking, is what can we expect from next gen, and also what are we doing to prepare next gen for engagement. So the next generation involvement in business, as you go across generationally, unless only one next generation member will effectively inherit the whole business and will consolidate, then you are looking at a fragmented potential approach. There are other ways to do this, but for our purposes today, if the next generation member will come in as a group, then obviously there's going to have to be some thought about how they cooperate, how they make decisions as a group. So part of this will be an analysis of where are we now? Do we have a family charter? Do we have a family agreement? Is there a trust? Has it been drafted with a view to dealing with a business, or is it drafted with holding an account with a major bank? So the analysis here is really looking at what have we got in place, if anything, and is it fit for purpose as we currently stand? Generally speaking, a lot of the business families will have family charters. They tend to be drafted by dad and with some assistance with a business consultant, and then we just leave it at that. These things are living documents. So family charters are a very important component part in all of this. They are aspirational documents, but they also set the soul of what the family is about. But then there's the operational aspect. Shareholder agreements, trusts, etc., become a lot more serious because these are operational documents that you can take to court. So the key bit here is, do we have anything in place? And if we do, is it fit for purpose, given what we're doing right now as a family and the age groups involved and the evolving characters of the next gen members? If we have nothing in place, then that's fine. We know the challenge there. Now, looking more closely at next gen, if we do have something in place, do we have a next gen development program? Are we actively encouraging next gen to get involved in the business? Is that working? Are they doing it sporadically? Is the intention that we just give shares, or is there an estate plan where we just have a transfer of ownership, but we've done no work on integrating them as their own team? What's the basis of future engagement? Have we even begun that? And then looking at the next gen themselves, the level of next gen commitment, interest, and ability. What the problem that we encounter with next gen is that they find more interesting things to do. And so it's difficult to persuade them to join what businesses that they would perhaps consider to be not sexy, not something that they can, brag to their friends about. That's the problem that we have. They want to do potentially, let's say, a tech startup or something. They're not interested, or they're professionals. They're, accountants or lawyers, or they're, surgeons. So they're not interested in value creating through a business or a trading entity. They're busy in their professions. And so that's an important aspect, because if we don't keep that under review, then there is a disconnect between what we hoped was the connective tissue across generations and actually the reality of the situation. And you don't want to be in a position where, because of next gen, there's nothing to hand off to. And so you end up in this unfortunate position that there is no business succession because there's no succession element to it. And then you end up with your life's work being harvested for, a penny in a dollar. So that's the issue around looking at the commitment. This is the most important aspect of the engagement. It's looking at next gen and commitment levels. Now, more seriously, is whether or not the family is in some level of conflict and some level of disagreement. Obviously, these, if they become quite serious, they will drive a lot of the strategic decisions that could be made. Mostly looking at exits and trying to shore up so that we can have an orderly exit on a sale. More latterly, looking at whether or not the relationship is abusive, whether or not we've got situations where branches are particularly not enmeshed, they've got nothing in place to help them, and so behavior pattern has been developing over time in an abusive way. And then the final bit on this is whether or not we have anything that actually speaks to dispute resolution. If we've got a shareholder agreement, does it have arbitration? If we've got a family charter, does that have a provision in dealing with, a family council meeting to discuss how we deal with members that are upset by decisions? So what do we have in place to manage disputes? So it's quite an important aspect, this, because it talks about not only the family's relationship with the business, but also the relationship with each other. And you put all of this together and you end up with looking at the decision tree of what actually can we do running through this. Now, here's generally what families would do in terms of decisions or strategic decisions or options. You can look at families that would recommit, so they would enhance the governance framework for the next gen. Next gen would be integrated in this context. So there's a recommitment. So they've gone through this exercise and everything's ticked the box. It's fine. And it's actually a good source of wealth. And the only thing they need to do really is to be careful that the next generation members have some framework through which they can work with each other. Other family members or families will look at separation. They'll divide the business, separate it up, units across different family branches. If they're lucky enough to have separate divisions that are roughly in the same value, or at least in the same interest pool as the next gen, then they would divide it up. They wouldn't keep it centralized, and members can effectively recycle the whole process and become their Gen 1, and then they will go on. So divide and separate is another way. The exclusion, so exclude and effectively equalize, is where, typically speaking, you're looking at a business family where you've got next-gen members that are interested, involved, and next-gen members who are not interested and not involved. And it's perhaps a good idea to look at only members who have got skin in the game should be involved in the business, and others should be equalized out. So they're not being treated unfairly. They get value equal to the amount of the business at that time. It's quite tricky to value a business in this scenario, but anyway, trying your best to equalize the members, but then you exclude the ones from operational aspects, owning shares in an operating company, because they will add no value and they could potentially become quite political. So the excluding and equalizing is an approach. And diversification. So you're looking at families who have got to the point where they do realize 90% of their eggs are in one basket, and they're looking carefully at how they can begin the process of diversifying. And here you look at what we would call an embedded family office. So it's the poor finance director who's now having to learn quickly what treasury bonds are and things like this. But it begins the process of professionalizing how the family would have a financial pool rather than just an investment or a trading pool of wealth. At some point, family will have to come to a decision about whether having all our eggs in one basket really is sustainable. And this is where diversification starts to come in. Transition. This is really for families that are committed to transitioning away from financial wealth into transitioning away from business or trading wealth into financial wealth. So they want to transpose across into a family office environment. There are many reasons why they want to do that, and we can run through that when I look at the matrix. But these are families that are committed to effectively exiting. So there are many cases. I mean, there's many that we can bring up. There's some of the major families that had things like the family in Australia that had the malls that exited because they were worried about Amazon and its effect on physical buying, and they exited at a very good time, consolidated in a family office, and now they've tripled their wealth 10 years later. So it's families that actually want to make the strategic decision to transition away from business wealth into financial wealth. And then, of course, there's a hybrid of all of these. So depending on the family dynamics, if they can separate out and then they can then look at transitioning or at least diversifying. So it's not an either or, right? It's an and potentially. So what does this look like if we were doing a chart? And this is crude, okay? You shouldn't follow this in terms of the nuance because there's going to be a lot of emotion around these things, but it can be helpful to see what this would look like in a chart form in a simplistic way, probably overly simplistic. So if you've got a business that's sustainable, sufficient, and everyone's engaged, next generation member are stellar, they're really good folks, then really you're looking at recommitment and governance reform. You're looking at making sure that you keep on, when you pass the baton, that it's in a very, very sophisticated way and that they are, into an environment that's supportive. And that's where the governance reform would come in. However, I think the second of the narratives there is probably more of what we're seeing in the first generation families that are handing off, and certainly from the second generation families, which is it's good businesses. They're sustainable, they're sufficient, but unfortunately there's a lack of engagement, and that really is the third gen at this point are the key problematic group. And there's the choices. So if you've got this scenario where you've actually got a very healthy business and it's a very good position and it generates very good profits, but the next gen is just not interested or not, in your view, sufficient to do it. They're not capable of operating the business. And then the options that you have is partition exclusion if you've got members that can take it on, where you can exit, or you're going to look at effectively looking at a long-term family office play of pure diversification, because what you want to avoid in this scenario, so scenario 2, is that you hand off a very healthy and a very good business to next generation members that have no interest and will probably plow it into the ground. Many Malaysian business families are facing this exact same situation now, which is they have good businesses. It's taken them a long time, but they have next gen members that are completely disinterested in it. Scenario 3 is we have a sustainable business, but it's not sufficient. So it's not generating enough for our long-term requirements. We've got an engaged family, but for that, it would have been, position 1. But here you look at a long-term diversification strategy because we know that the business is not sufficient to maintain the overall lifestyle requirements of next gen. And so diversifying away, family office is one of them. It could be diversifying into other businesses as well. But generally speaking, you'd want to diversify the risk as well. So financial assets diversified tends to be the approach with a family office. If the business is not sustainable, then it can't be sufficient either. And in that case, you're looking at transitioning to a family office. In other words, this is as rich as you'll ever be. And so you should really try and consolidate this and move it across into something that's less risky. Because if the sustainability issue is that we can't reverse this, we're in a declining industry, then you need to at some point call it quits and transition out to an asset class that it doesn't have this same dynamic. The last one is the most depressing one, is it's not sustainable, not sufficient, and no one likes each other. So there we are. I think at that point, you need to put your best foot forward and try and get a trade sale and see what you can get on an exit and then see what members can do. But that's the worst scenario, and anyone in this scenario, my commiserations, because it's absolute nightmare being in that scenario. And unfortunately, it's more than we know, right? A lot of the families are not surfacing a lot of these issues. And so really, you should be looking at an orderly exit and trying to get as much as possible on an M&A sale. So that's broadly how it would look. It's not sophisticated, okay? So this is a very crude way of looking at a problem. There's a lot of emotion swirling around what's going on this diagram, but it gives you some idea of the direction of travel if you found yourself in a position where particularly there's a little red X on your analysis. Then it gives you some idea of the potential way in which you can engage and try and manage the problem. Okay, in summary, business families face high succession failure rates due to weak governance, no succession plan, lack of professionalization, financial mismanagement, and ultimate wealth fragmentation. That's our challenge. That's where we are. The strategic rule helps families make better strategic decisions involving assessment of the following: the sustainability of the business. This tests the position of the business cycle, the management quality, capital reserves, and the overall risk. It gives you a good snapshot of effectively how healthy is the business. The sufficiency. This evaluates the cash demands placed on the business, both to operate and meet family liquidity demands, both now and, crucially, the next generation requirements, resulting in a carry capacity and a growth target. Now, if that growth target is realistic, then that's great. We can continue on. But it's good to keep this under control to make sure that our spending requirements are within line. Engagement. This tests the level of and quality of family involvement, conflict levels, and existing family governance framework. If we've got nothing in place, if we're not sophisticated here, we need to do more work, particularly cross-generationally. The engagement test is the crucial one because that's the connective tissue of the family together and the business. Decision. This sets out the main options available to the family as a result of the strategic review, including recommitment to the business, separation or transition to a financial family away from a business family. So, in final, the strategic review is the critical first step to begin the process of effective business succession planning. This is so critical. If you need to go through this before you can even begin to look at structures and talking to trust companies and beginning the process of trying to create a fiduciary structure somewhere in the BVI or something, you would have to have gone through all of this first to know the correct approach for your family. Okay, so thanks very much for listening. There's a Q&A section that we're going to kind of get into now.
Yes, thanks. Thanks very much, Zach. That was great. Now, we've had several questions that have come up leading up to this webinar, and I'll try and sort of group some of these together. To start off with, you've obviously worked with many families across, different cultures, geographies. So in your experience, having done this for many years, why do many founders postpone, governance and succession planning, even when they intellectually understand the risks of doing so?
And they fall into two camps, and again, being crude. There's one camp that they don't see it as their problem. So they know that there is this business problem, but they see it really as a next-gen problem for them to deal with it. I've had meetings where I've had a first-gen say that to me directly. This is not my problem. This is going to be the next generation's problem. And so they should be the ones being educated around this, not me. Then there's the other group where they do know about this. I think all the business owners know about this. I think none of them will be shocked at anything that I've just said. But they're just too busy. And they don't want to deal with something of the magnitude of this sort of conversation, because the emotions that would come around. I'll give you an example. So I was in Taipei at the weekend talking to a business family group there. And it became very obvious that discussions around business succession, particularly where it came to things like transitioning to a family office, was seen as a complete abandonment of the family's legacy. Complete abandonment. And that was difficult for anyone to imagine, particularly if the family name was a marquee name, and we had a number of those in the room. And so it would be, the challenge there is that it's looking as if it's some way disrespecting previous generations' work to think in these terms. There we are. If a business failure happens, that's the worst disrespect, I would suggest. Then we transition to something that didn't necessarily carry the family's name otherwise than on a plaque to do with the family office, let's say. I understand that there is a very big emotive aspect to this. So what I do know is that business owners know all this stuff. They do understand. They understand the risks. They know about this, but they elect, for whatever reason, to really foist it onto next gen to deal with it, whether knowingly or unknowingly. It's a next gen problem. And I have to say, the ones that say this is not my problem, Zach, I'm busy, I agree. It isn't your problem because you're fine. You did all of this on your own without anybody in a suit talking to you. You're fine. Next gen really is their problem, but they somehow, the next gen, find it difficult to begin to engage on this between each other without first gen saying it's okay to do that. And that's perhaps where the disconnect can be, better dealt with. But that's basically what we're seeing in the market. Now, even talks like this, right? Even if we had first-gen members watching a talk like this, 80% wouldn't do anything after it. They would be within the do-nothing camp. It's very exceptional for a family, particularly a senior generation, to actually take the advice and then begin the process of strategic planning. The statistics are not there for a joke. They're actually real. And many times there are very, very intelligent people that are failing. So that's part of it. And I think it's mostly emotional. That's why.
Thanks, Zach. Just leading on from that, like you said, if 80% of the bulk of the folks don't follow through, what about having gone through a strategic review, what you've just covered today, right? So they've done the strategic review. In your experience, are there any patterns you see as to, what percentage do actually go to the next stage post the strategic review?
I think it's again fairly low. It's interesting because you can do these conversations and then families will listen and you won't see them for 18 months. And then one of them will just pop up and say, oh yeah, by the way, we were thinking about, and it just gives you some idea of the rebound effect. So I always ask, whenever a family talks to me, I always ask them, how long have you been thinking about this before you actually talk to an advisor or try to get in touch? Generally, it's about 10 years. And that's amazing. So we've literally been thinking about this for 10 years and done nothing. Other regions show differences, okay? So the Indonesian families, let's say, it's a bit quicker than that, right? But generally speaking, if we're, let's say, dealing with other Southeast Asia, Philippines or Thailand, then it tends to be that this has been talked about for ages and we haven't done anything. So these strategic reviews are good because they're exceptionally good for next gen because it keeps it on the agenda of, are we doing things? Are we doing things properly? Are we getting the right advice? Are we strong? Are we weak? But yeah, it's difficult.
Yeah, and I think finally, like you said, there are some nuances, sensitivities, right? There's emotions, there's the
Yeah.
different generations. Um, and the irony of the fact is, some clients are very close to their advisors, but again, why do some of these families, often view the formal, engagement and formal governance and professionalization as as sometimes a loss of flexibility and or trust?
Yeah. It's exactly like a prenuptial arrangement. If you want to have a romance killer, then whip out a 50-page prenuptial agreement in the middle of the arrangements to consummate a marriage. That's the problem. It sort of brings in an element of commerciality which seems out of place in a family relationship. And it's exactly the same sentiment with a prenuptial. It's very delicate to commercialize, as it were, what is something based on trust and relationship. It's very difficult, and some families are very enmeshed. And to then say let's formalize this is almost a joke. It's like, well, but therein lies the problem, right? Is it may not always be like that. So it's very exceptional for families to be able to luck it through, and they do. These documents, this working arrangement can help tremendously to set the parameters of the playing field, particularly, and this is really where it comes in, is particularly if you have that one family member that comes through that actually is quite selfish, quite self-absorbed, or has problems. Could be addiction problems, could be some resentment issues, etc. So again, back to emotions, back to controlling people, acting in the right way. These documents help to set that parameter as a baseline insurance. And there we are, and that's the best it can do. But it really introduces a commerciality into a high trust relationship, which is seems inappropriate, frankly. And that's the problem with this.
Great, thanks, Zach. I think we've pretty much very close to coming to the end. So just wanted to thank you, Zach, and to everyone. We'd be happy to have further discussions and address any questions that you may have. Of course, your advisors will be very happy to organize calls or meetings with Zach for any specific questions. Zach, just before we end, as I said, we're doing this webinar series together with you. We've done the first one, maybe just a one-liner on the subsequent two that will be coming in the next couple of weeks. If you can just share a quick brief on that, and then we'll close. Thanks.
Yes. So the one that follows this, it sets out how we create governance frameworks that are hygienic. In other words, what do we need to have in these things that help with decision making and help avoid disputes and disagreements, crucially. And so that sets out, and it's the idea behind this is the governance framework is not tied to any particular structural solution. It's of itself. So it's the substance of what the rules should say, regardless of how you operationalize it, whether through a contract or a trust or other device. And then the final session will look at structures that actually operationalizing the governance framework. And it looks at the, gives some evaluation of the different use cases around using a contract and how does a family charter integrate with, or what are the risks of a family charter integrating with a shareholder agreement across family members, and how do we use trusts, what's the best way, differences between the different types of trusts. And it's obviously all generic, but it looks at the different ways in which we can encapsulate and obviously operationalize the governance framework. And the whole idea around the governance framework was that was part of the arrangement of us getting better at being cross-generational in sustaining a business. And then if it's a family office, the same thing recurs. We still have to go cross-generationally, so we still have to think carefully about how we're going to operate together, where there's a lot more members than just one. So that's what we're coming. That's what we're coming up. The dates will be, fixed in due course. But those are the following sessions.
Great, thanks, Zach. And as I said, we'll send out the details to everyone for the next two sessions in due course. Thank you very much, Zach. That was very useful. And of course, thanks to everyone who had taken their time to join us today. Have a good rest of the week. Thank you.
Thanks very much. Thank you. Bye-bye.
Bye.